Good morning and welcome to the Addition Financial Webinar, HELOC, What You Need to Know. Our speakers this morning, Joy Winslow and Heidi Pauley, are sharing their expertise from our real estate department. Feel free to type your questions in the chat box and we will answer them during our Q&A session towards the end of the presentation. And now I'll hand it over to Heidi.
All right, thank you. Good morning, everyone. Thanks for joining us here. So I'm so happy that you decided to join us today. Please make sure, take a second if you don't already have it, grab a pen and paper, take some notes because we've got some actual math calculations that you can do today. I bet you didn't prepare for that. So let's get started. So today's topic's all about HELOCs. So we're going to learn in this session, what is a HELOC? Why would a member want a HELOC? Interest rate, variable or fixed? How long can I have my HELOC? When will my payment be? And how will I qualify for a HELOC? So for those that aren't well knowledgeable yet on what a HELOC is actually a home equity line of credit. This is a loan that uses the equity in your primary residence, a vacation home, or a second home as collateral. Unfortunately, for those of you with investment properties, we cannot do a HELOC on an investment property. So to continue on, the HELOC, or home equity line of credit, this is actually a secured loan by a mortgage recorded on the property, which is your primary residence. This property must be located in Florida. Addition Financial can lend up to 80% of your home's value minus any outstanding mortgages. The other nice little caveat is this, that if you have your first mortgage with Addition, we actually can calculate your loan to value and lend up to 90%. Of course, there are lots of, some criteria that we go to decide what we can lend to, but that's a good indication of what we can, if it's 90% with an Addition loan or 80% if your mortgage is held with somebody else. If you're looking to get a HELOC and you just need something minimal, we do start with our minimum credit line of $10,000. The highest we can go is $500,000, which is pretty amazing. And what in the world would you possibly use your HELOC for? So the beauty of this HELOC is that for some people who are looking to pay off some debts, if you've got lots of high credit card, we know that those are revolving with sometimes 25% interest. Knock those out, we can pay those off. Home repairs, if your home is a little outdated and it needs a fresh look, it needs a little facelift, maybe some cabinets, a new bathroom, modernize it a little bit. This is great for that HELOC. And renovations. We live in Florida and the unexpected come. You never know when those hurricanes are going to hit us. Repairing roofs and windows. Those are a wonderful thing to use the HELOC for. So I bet you're wondering, is this a good fit for me? Do I really need this? So a good thing to consider is that this is going to be a good choice for you if you like to have funds available and use them repeatedly. So you'll have the ability to use this, pay it down, pay it off to a zero balance, and still keep the HELOC open while it sits there. So kind of think of it as it's a credit card with no plastic, and the interest rate is significantly lower. So Joy, I'm sure they're wanting to know what an interest rates, whether it's variable or fixed.
I want to thank you for attending also and hope you learn lots with this webinar today. I'm going to talk about whether the HELOC has a fixed rate or a variable rate. Our HELOCs do have a variable interest rate, and that is subject to change each month based on the value of the index on which the HELOC is based. We base our HELOCs on prime rate, which is published in the Wall Street Journal each month. We do add a margin to that rate, and that margin is established based on your loan to value and your credit score. We base this as a tiered rate, so it's not something we can quote to you without knowing what your credit score is and what we think your combined loan to value will be. The margin is a pre-established amount based on these criteria and will not change during the term of the loan. However, as mentioned, the index, the prime rate, will and can change monthly. We based all this on tiers, and they're different for whether you have a Addition first mortgage or not. So you can go online and apply, and then we can get you a quote on what your index and margin might be. Draw period. How long can you have that HELOC? We give you a 20-year draw period, which means you can use this loan, pay it off, use it again, pay it off for 20 years. So at the end of 20 years, let's just say you have a balance of $20,000 or whatever. We don't require you pay that off at that time. We will now turn this loan into a 15-year amortized loan. So the actual full term of this loan is up to 35 years. And over that 15-year period, after the draw period ends, that will pay this loan off at the end of the 15 years. Of course, you can pay it off sooner if you'd like. And like I said, it's available. The draw period is 20 years unless you close it previous to that. Repayment period. And this is what we just talked about again. You're required to make monthly payments during the draw period. At the end of the draw period, again, you have the 15-year payoff. And it's still a variable rate loan during that last 15 years. So the interest rate will still continue to change based on the change of the index, but your margin will stay the same. Okay, so payments. Monthly payments on a HELOC are calculated on your outstanding balance at the interest rate in effect for the period of 180 months. So for an example, you have a HELOC with a $50,000 limit, but you've only used $15,000 of it. So your payment for this month is going to be calculated on the $15,000 plus any interest, and the payment is calculated as if it was a 15-year loan. So with every payment, you do make some principal reduction. Unlike some HELOCs out there where you strictly pay interest, we do have you pay some principal reduction in every payment. We do have a minimum monthly payment of $50 or the regular monthly payment, whichever is greater. Now I'm going to turn it back over to Heidi to give you some more information on payments and due dates.
All right, so you've got your HELOC. It's great, you've used it, and now it's time to make your payment. There we go. So the payment due date, your payment is actually going to be due on the last day of the month. So very basic. This is going to be your set fixed due date. Just remember, it's your due date. You can pay it before, just not after, because then you do get that late fee. So once you are ready to actually start withdrawing and take cash out of your HELOC and use it, you're able to do so by withdrawing in $500 advances. So the first one is $500, and then any additional withdrawal or advance is going to be $500 after that. To have that available to you, if you have online banking, you can withdraw from your online banking. You can do an advance from your HELOC to your account. You can also call in over the phone and request that, or also in the mail. So one thing to think about is that if this is a joint HELOC, a borrower and co-borrower, remember that either of you are able to request an advance without the other's authorization. On the other side of that, either of you, borrower or co-borrower, are also able to close the line of credit. However, that must be a written request to close that. And also keep in mind that after that 20-year mark, you are no longer able to do advances and use that cash. It then goes into the repayment period. And now we're moving on to, can you keep this loan if you sell your mortgage? So we've got the HELOCs that are not assumable, which this just means that once your home is paid off, once the property is sold, the HELOC is actually paid off and you no longer have that. It's paid in full. All right, Jory, so give us some ideas on how do we qualify for a HELOC?
Okay, well, that gets a little involved. We require you have a debt to income ratio of no more than 45%. When calculating a debt to income ratio, the payment for the HELOC is amortized using the current interest rate and the full line amount over a 15-year period. So if you have a $100,000 equity loan, to qualify you, we're going to calculate the payment on the full $100,000 that would be available to you. So how do you calculate a debt to income ratio? We add all your monthly debts off of your credit report and the payment on the home equity loan at the fully amortized balance, and we divide that by your monthly gross income. That's how we get your debt to income. One thing I did want to mention, because it comes up a lot, if you have student loans on your credit report and they're in deferment, which I think all of them are at this point in time because of the pandemic, we still have to count a payment on those student loans because at some point in time, you're going to have to start paying those back. So we do count 0.5% of the balance as a payment in your debt to income ratio. So you need to remember that. That does sometimes add up on these student loans.
Yeah, we've seen that come across lots of times with
Yep.
I don't have a payment, or and so you think that you can not have to calculate it. But again, a lot of people don't realize that those are loans that are not going anywhere and do have to be repaid.
Exactly. So that's why I wanted to mention that. Now let's talk about how we calculate your loan to value ratio. We have the maximum of the 80% loan to value, as mentioned by Heidi earlier, if you have a first mortgage that is not with Addition Financial, and a 90% combined loan to value if you do have an Addition first mortgage. So that's a real benefit to have your first mortgage with Addition and then get a HELOC behind that. You can get more available funds. And then we're going to talk about how to determine income and calculate debt ratios and what is needed for us to calculate your debt to income ratio. So if you're a salaried borrower, that means you have W-2 income from an employer. We're going to need a current pay stub for each borrower. We're going to need the previous year's W-2 for each borrower. If you get overtime and it's needed to qualify for your debt to income, we're going to need 2 years of W-2 so that we can average that overtime income, and a current pay stub with an end date within 30 days of closing. So again, we can use the year-to-date overtime to average it. And within 30 days, we're going to need to get a verbal verification of employment if you can't provide the current pay stub, or if your loan is over $100,000. And we will call your employer and verbally get the information. If you have several jobs and you haven't worked 2 jobs for 2 full years, we can only use income from your primary job. If you have the 2 jobs and have worked them for 2 years, we will consider looking at both incomes. Rental income. Let's say you're lucky enough to have a couple investment properties that you collect rent on. Okay, so that throws a whole new thing into the qualifying. Now we're going to need 1 year of tax returns to qualify you, or a lease agreement. And then we only use 75% of the actual rent you collect, because we charge a 25% what's called a vacancy factor. If your home doesn't have a tenant in it or something like that, that's considered vacancy. Okay, so let's say you're self-employed. Okay, we need 1 year of tax returns. If all of your self-employment is on a Schedule C on your personal tax return, then we only need the personal tax return. However, if you have a corporation or limited liability corporation or something like that, that you file a separate business tax return, we are going to need the business tax return also, and any K-1s that you might get to verify your income and to calculate it out. Now, if you're lucky enough to be retired, what will we need to verify that income? We're going to need a most recent 1099 from the previous year, an awards letter, which you normally get for Social Security at the beginning of every year, telling you what your income will be with Social Security, and or bank statements to see what your deposits are for Social Security. However, if we use the bank statements, that usually is the amount deposited is after Medicare, or if you have taxes taken out, it is the lesser amount. And we can use, if you have an award letter, the higher amount before any deductions to qualify you.
Wow, Joy, that seems like a lot.
It is a lot, but it really isn't when you think about it. We'll do all the work in qualifying you. You just need to provide all the documentation.
It seems overwhelming at first when you're trying to look at, oh my gosh, I need this and this and this. It's really not. One thing I'd like to say is that here at Addition, we will work with you. Any questions that you have, if you're not sure of anything, we're happy to. We are going to walk you through the process step by step with any questions. And of course, there are case-by-case scenarios that may not always be listed on here too. So we are happy to answer any questions that you have.
And we have several ways you can get this documentation to us. You can always take it by a branch, your local branch, and they will be happy to scan it into us. Or we'll send you a secure link. If you have most of this stuff electronically, you can just download it into this secure link and it will automatically come to us. We try to make it as simple as possible for you. And again, like Heidi said, we will walk you through each step all the way through. So just know that we're here for you. And now Heidi will talk to you about some property types that will
All right.
loan on.
Thanks, Joy. So qualifying for a HELOC. So we've just gone over the income that's required to qualify you. Now it's about qualifying the property. So the property type that we really look at is going to be, it must be mortgaged, of course, a 1 to 4 family dwelling that is used as your primary residence. This is the key thing to remember: primary residence, second home, or vacation. So in addition, we will not hold a second lien position on a mobile or manufactured home. So it's got to be the primary residency, the only mortgage that we can do the HELOC after the first mortgage.
But Heidi, will we do a HELOC on the manufactured home if there's no first mortgage on it?
Oh, yes.
Okay.
Yes, we sure can. Yes, that is. And that's great if you don't have a mortgage on it. That's always great to not have a mortgage. So kudos if you don't.
Just remember, if it's a mobile or manufactured home, you have to own the land.
Own the land.
Also,
Yes.
it has to be real property.
Cannot be in a park. You have to own the land. But there are some places that, have, again, they have manufactured communities, and then you do actually own the land. So that is a key thing to remember. You must own the land. The location of your home. Now, I know we are in the South, and again, me being from the North, got to represent the Northeast. Some people have second homes up north or anywhere. However, that property must be located in Florida. So if you've got your second home, that's vacation home, and you're heading to the beach, great. As long as it's in Florida, it does qualify for a HELOC. We do look at appraisals. Appraisals are something that we must do that gives us an idea of what the value is. So there's a couple of different appraisals that we can do. If the loan amount for the HELOC is going to be $100,000 or less. The beauty is that we're able to do what's called an AVM or a QSAR for appraisal. These are electronic, and we're able to reduce the cost of what a full appraisal would be. If your loan value does exceed $100,000, it will require a full appraisal, which is $450, and that is an out-of-pocket fee. But no worries, you will receive a credit when it does come time to closing. So you're not going to be double charged. So you will receive a credit as part of closing. And remember that the CLTV does not exceed 80%. So of course, we're talking about CLTV not exceeding percentages. What is that? What is a CLTV and how do you calculate it? So a combined loan to value is what a CLTV is. So to get this, it's actually a ratio of the loans on your property to the property value. And this is where I said having, again, with these math calculations, is having your pen and paper. If you know this, or even that way, it kind of gives you a little bit of homework to do some research and see what your value is on your home. So first thing is first, if you are wanting a HELOC and the first mortgage is not with Addition, that's going to be 80%, which is the max that we can lend. So let's just say that your mortgage, your first mortgage, is $114,000, and the HELOC you're wanting to apply for is $52,000. So to get your total combined loan to value, you're going to add the two, the 114 and the 52, and that's going to give you a total loan value of $166,000. So then it's to find the value of your property. And for example, let's just say your value is $335,000. Your simple quick calculation is going to be to divide the $166,000 combined loan to value, and then your property value, which is $335,000, and that's going to get you 49%. So you'll see that you do fall under that 80%. So then that is something that we could look into as a qualifying factor for your HELOC.
And remember, if you're only at a 49% loan to value, you can go higher and just not use the funds.
Exactly. There you go.
So you have it available for emergencies.
And you never know, again, with HELOCs, they're not used solely just for debt consolidations and renovations. There really are endless reasons that you could use it. So it's always nice to, I like to say, keep it in your back pocket to always have, just because you know, emergencies come up and you just never know when you might need it. So how qualifying for the HELOC in a lien position? So as we've talked about, first position, second position, a HELOC can be used in either or, in a first or second position. So the first position, what that means is that it's the only mortgage on a property. A second lien means that there's an existing mortgage on the property, and the new loan will then be the second lien. And Addition Financial does not permit any liens greater than the second lien. So another thing that's going to qualify you, we do look at these things, and actually these are required, hazard insurance. So I'm sure for those of you who are knowledgeable know hazard insurance, but a little funny story I'm going to share. I am a newly homeowner, and been doing this, but you don't think hazard insurance, everything is referred to as homeowners insurance. Hazard insurance is actually homeowners insurance. So we do require the policy. I had actually received a letter saying that my mortgage company did my hazard insurance, and I panicked for a near second and said, wait a minute, I don't have hazard insurance. And then I got to call the insurance company, and they said, no, you have hazard. It's actually your homeowner's insurance. So let me just clarify that to everybody out there. Hazard insurance is your homeowner's insurance. So we do actually require this. This is something you have to have. Again, it's insurance for your home. So we are looking that the policy must insure at least 90% of the appraised value of the home, or guaranteeing 100% replacement cost of the dwelling should anything happen to it. Not all homes, some homes do require flood insurance. Again, we do live in Florida, and you may be surprised, but what you don't think is a flood zone may very well be. So in that aspect, flood insurance would be required. So if you are found to be located in a flood zone, you must, prior to disbursement of the loan, obtain flood insurance in the amount of at least equal to the amount of the loan, and maintain it for the duration of the loan. And you must, and again, this is something that as you're going through the process, and if your home is determined to be in a flood zone, we'll go everything, all the requirements, but keep in mind that Addition Financial must be listed as mortgagee and loss payee on your flood insurance policy. So we have some amazing benefits on why to choose Addition. So Joy, what are some reasons why members should choose Addition for their HELOC?
Because we're wonderful.
Always. Woo-woo.
We do have some specials going on for HELOCs. First off, we will pay up to $1,000 towards your closing costs. Most of the time, this is going to cover the majority of your closing costs on your HELOC. But remember, you do have to pay for that appraisal up front. So if you pay for that appraisal up front, that can still be considered. The other benefit we have is we don't charge you a monthly fee on our HELOCs. We don't have a maintenance charge, and there's no penalty for not using that HELOC. That goes back to saying you can get this and just let it sit out there for an emergency if you want. In case we have a hurricane and you lose your roof, that money can be sitting there. And again, you can, like we mentioned, you can have more than, if you think you only want a $50,000, but your combined loan to value lets you have up to $100,000. You can take out that mortgage for $100,000 and just let it sit there. We're not going to charge you any fees for not using it. However, if you should take out the HELOC and we pay these closing costs for you, if you close that HELOC within the first 36 months, 3 years, we do ask for that money to be reimbursed to Addition Financial for any closing costs that Addition paid for you. So just remember that. You'll want to keep that HELOC longer than 36 months if we're paying those closing costs for you. Okay, so what other equity products does Addition Financial offer? Okay, say you don't like a variable rate HELOC. You're scared of the rate changing and going up and down, and that just isn't something you're comfortable with. Well, we do have another option for you. We offer a fixed rate second mortgage in a second lien position. So you have to have a first mortgage to get this fixed rate second mortgage, but your payments will be fixed. They will not change. The interest rate will not change for the term of the loan. And there's different terms we can do on that. So if you're interested in that, we'd be glad to talk to you about it. Another fabulous product we have is called our Fast Track Mortgage. This is a first position lien. You can use it to pay off your current first mortgage. We'll loan up to 80% of your value of your home. You do not pay escrows on this loan, so you would be responsible for paying your own taxes and insurance, even though it's a first position mortgage, which some people like that. We'll do 80%, except on manufactured or mobile homes, we'll only do a 70% loan to value on the Fast Track Mortgage. We have the same minimum of $10,000 and maximum of $500,000. And we do offer some closing costs on this Fast Track Mortgage also, but it's only $250,000 that we will pay towards your closing costs. This loan's intended for those that are wishing to pay off their mortgage by reducing their term and interest rate. Let's say you think you're going to want to retire in 10 years, and you think you can afford right now to make a payment on that in 10 years. These interest rates are very attractive, so you might want to check out our website or call us and see what the interest rates are on these Fast Track mortgages if you think that's something that you would be interested in. Heidi, do you have anything else to add?
For those questioning, we've talked about prime. The 3.25
is current
prime right now. So again, as we said, yes, this is a variable rate, but the rate is not, again, as we said, it's a revolving, it's not like a credit card. So your rate is not going to be astronomical. It is prime right now, which is 3.25.
Plus whatever your margin would be based on, again, your loan to value and credit score. And also whether you have an Addition first mortgage or not.
So it's not as simple as looking at the 30-year fixed rate to get your interest rate. There does require a little bit of extra work on our end to see what it is actually that your basis will be on. But that is a very great rate right now that prime is at.
So just remember, we do offer regular first mortgages also. If you're looking to just refinance your home, that's something else we can offer. Rates are really good on that right now. And you can do a refinance and a HELOC all at the same time if that's what you're interested in doing, to have that HELOC sitting out there for, like we talked about, emergencies or whatever could come up. So now I think we will go on to questions and answers.
We're going to have a brief intermission to review the questions that have come in, and we'll return in just a moment.
All right, so some questions have come in. So we're going to go ahead and answer those questions for you for what we have. All right, Joy, go ahead. What was the first one?
Okay, we had several questions asking about fees, and we do not have any fees. You can open it and not use it, and you would not have any monthly fees, okay? And then Heidi, you want to talk about debt to income?
Yeah, absolutely. So someone had asked if you are an authorized user and it's showing up on your credit report, does that get counted in your DTI? And it actually does not. You are an authorized user. You don't have the legal responsibility for that debt. Someone has just so kindly allowed you to utilize that card, usually for purposes of building credit. We actually remove that as a liability, so that is not included in your debt to income ratio.
Okay, we had a question about loan to value, and if you don't have any mortgage on your property, we do limit you to an 80% loan to value on our home equity line of credit. So that's if you don't have a first mortgage, you can do up to 80% of your home value.
I know we keep talking about the 80%. I know this is something that's really, for those with the mortgage is that private mortgage insurance, a PMI. So that eliminates any of that. One of the other questions is kind of specific for a retired person with no Social Security income. We require income. There has to be proof of income or receiving regular distributions. So there must be evidence of some source of income or regular distributions.
When we say distributions, that would be on your IRA or annuity or something like that, that you can show that you take regular distributions and claim that as income on your tax return.
And it looks to continue for the next 3 years, correct?
Yes, it has to be able to continue. So your balance in that IRA has to be enough to cover that we can see you can take distributions for at least the next 3 years. Average credit score. We do require at least a 650 credit score for our HELOCs. But you can always call and talk to us about what you think your credit score is, and we'd be glad to offer you some help on that.
All right, so the next question we're talking about, I know that I had mentioned AVMs, QSARs for appraisals. So the AVM is actually considered an electronic appraisal. That's based on public records from the county. Those come from additional sources. And that way it just kind of gathers, it's more of a desktop electronic. So there isn't actually anybody going to your home. Kind of a quick evaluation. This also costs less. We can use this again if the loan is going to be $100,000 or less. That's for the AVM or electronic appraisal. The QSAR appraisal. This is actually considered a full appraisal. It's interior. It's just not as extensive as a full appraisal. And it's not nearly as extensive as a full purchase, not as many comparisons to other properties. This one does actually cost a little less than a full appraisal as well. So that's the beauty of being able to do either a QSAR appraisal or the AVM as opposed to a full appraisal.
Okay, and someone asked if you can have 2 HELOCs, and no, you cannot. So if you have a HELOC with another institution, then if you wanted to take a HELOC out with us, we would pay that HELOC off and we would be a new HELOC for you. So you can't have 2 separate HELOC loans with 2 institutions. I hope that answered all your questions. Someone did ask if we have a financial advisor that they can talk to, and they can call our main number at 407-896-9411 and ask for the real estate department, or you can go to our website, or you can go to any of our local branches and they would be happy to talk to you about qualifying for a HELOC or any of our real estate products.
Thanks, Heidi and Joy. This concludes our presentation today. Check your inboxes for an email containing a link to the recording, and thank you all again for joining us. Enjoy the rest of your day.